The core problem. Why your focus is worth trillions. Stop scrolling for a second. I mean it, right now. How many hours have you spent this week looking at this screen? Every minute, every tap, every frustrated skip ad, you're generating data. And that data isn't just metadata, it's currency. For decades, we talked about oil, gold, and land. Today, the world's most valuable asset is the predictability of your behavior. Welcome to the attention economy. Forget the products they sell. The $3.6 trillion market isn't driven by phones or software. It's driven by the ability to answer one question: what will you do next? The Data War Declaration. Your focus, your time is the scarcity. And where there is scarcity, there is massive, explosive profit. We are moving beyond the simple concept of advertising. These companies are engaged in a sophisticated trillion-dollar war to engineer your habits, from what you buy, to who you vote for, to how you feel. You are not just a consumer, you are the product's ultimate, irreplaceable resource. The investor's question: what if? This raises the fundamental investment question for the 21st century. It's the what-if scenario we must confront. What if the biggest, safest, most consistent growth stock of the next decade isn't a company that captures data, but a company that helps you defend it? What if the smart money starts flowing not towards attention harvesting, but away from it? To navigate this market, we need a map. In the next section, we're breaking the attention economy into 3 distinct investment layers. The final, and perhaps most disruptive layer, is the defenders. These are the companies capitalizing on the growing pushback against the attention economy. As users grow tired of digital fatigue, invasive tracking, and endless ads, they are willing to pay a premium for clean, private, and focused digital experiences. Defenders include premium, ad-free subscription services, advanced cybersecurity firms focused on consumer privacy, and disruptive technologies like decentralized web tools and zero-knowledge proof encryption. Investing in this layer is a hedge against the inevitable regulatory crackdowns and growing consumer distrust. It's an investment in the future where trust and privacy become high-margin features, not compromises. We've seen where the attention is captured, Layer 1, and how it's monetized, Layer 2. But how do these platforms ensure that billions of people return day after day? The answer lies in behavioral economics, specifically the hook model. This model is a 4-step cycle that powers the stickiest products: a trigger, a notification, an action, opening the app, a variable reward, the unpredictable post, the unexpected like, the new match, and finally an investment, adding content or data, locking you further into the service. For the investor, understanding this psychological framework is crucial. You're not just analyzing tech, you're analyzing digital habit formation. When a company effectively builds a product that operates on this hook cycle, its valuation becomes disconnected from traditional metrics and instead reflects its sheer power over human behavior. The investor's KPIs, where the value hides. So what metrics truly matter in this psychological market? Forget price-to-earnings ratios for a moment. You need to look at DAU to MAU ratio, daily active users to monthly active users. This is the ultimate measure of addiction. A high ratio signals strong daily habituation, meaning the platform is deeply embedded in the user's life and is difficult to replace. Churn rate. How quickly are users abandoning the platform? A low churn rate for a capturer stock means their hook is working, securing future advertising revenue and justifying high market capitalization. Average revenue per user, ARPU. This shows how effectively a company is translating attention, DAU to MAU, into hard cash. These key performance indicators are your direct link to the success of their behavioral engineering. When these numbers spike, the market recognizes their power to influence, and the stock price follows. C. The internal risk, overstimulation and escape. But this relentless pursuit of attention creates its own risk, digital exhaustion. What happens when companies push too hard? Users hit a wall. They seek out low-attention economies, premium newsletters, curated content, physical books, or simply turning off their notifications entirely. We are starting to see the growth of products and services specifically designed to help people escape the hook model. For the savvy investor, this shift represents the internal risk to layer one, the capturers. If platforms become too noisy, too manipulative, or too exhausting, users will migrate, leading to lower DAU to MAU and a catastrophic drop in valuation. The biggest threat to the attention economy isn't regulation, it's user burnout. The regulatory hammer, increasing the cost of data. The biggest external threat to the giants of the attention economy is not a competitor, it is the legislator. For years, companies treated data as a free resource, available for unlimited harvesting. That era is over. Global regulations, from Europe's GDPR to the CCPA in California, are fundamentally changing the cost structure of collecting and using user attention. These laws impose huge fines for data misuse and mandate strict user consent. For companies in Layer 2, the translators, compliance means increased operational costs and less raw material, data to feed their monetization engines. This regulatory hammer introduces massive systemic risk. Investors must calculate how much of a company's valuation is built on practices that may be illegal or restricted tomorrow. B. The Apple effect, a billion-dollar policy shift. But the threat isn't just governmental. Sometimes a competitor's policy shift can be just as devastating. Consider the Apple effect. When Apple introduced its app tracking transparency framework, forcing users to explicitly opt in to tracking across apps, it wiped billions off the valuations of companies like Meta almost overnight. Why? Because a large segment of users said no to tracking. This demonstrates the fragility of the attention economy model. It operates on a permission structure that can be revoked by a single dominant platform owner. For investors, this creates an asymmetrical risk. A small policy change from a gatekeeper can lead to a massive erosion of revenue for the capturers and the translators. C. The new opportunity, privacy by design. However, where there is risk, there is investment opportunity. The next generation of high-growth companies, the Layer 3 defenders, are turning regulation and distrust into a competitive advantage. They are embracing privacy by design. They build products where privacy and security are not optional afterthoughts, but core features that users pay a premium for. Look for firms innovating in areas like zero-knowledge proof encryption, which allows data verification without revealing the data itself, or decentralized finance platforms that reduce reliance on central authorities. Investing here is betting on the future where users demand control and are happy to escape the noise. The privacy wall, for some, is a moat built for new ethical market leaders. We've dissected the attention economy into three critical layers: the capturers, the translators, and the defenders. Now, here is your final framework for navigating this massive market over the next decade. Monitor the metrics of addiction. Layer 1. If you invest in capturers, prioritize companies with the highest and most consistent DAU-MAU ratios, as their psychological hook is strongest. Bet on efficiency. Layer 2. Look for translators who are adapting best to privacy regulations, finding new ways to monetize data without being invasive, focusing on contextual advertising rather than personal tracking. Hedge with the defenders. Layer 3. Treat privacy and cybersecurity firms as your essential defensive hedge against systemic risk and user burnout. These are the future growth stocks that monetize trust. B. The ultimate warning and challenge. The core truth of the attention economy is simple, yet devastating. If you are not paying for the product, you are the product. Your attention is finite, and the world's most powerful companies are designed to consume it until nothing is left. This isn't just a financial discussion, it's a discussion about control. Every time you open an app, you are either contributing to a company's bottom line or extracting value from it. The goal is to maximize the latter and minimize the former. The call to action. So, here is your final challenge. Open your phone. Analyze your digital portfolio. Which companies hold your attention? Are they the same companies that hold your financial investments? If you are sacrificing hours of your time daily to a platform that you don't invest in, you are subsidizing someone else's wealth creation. Don't just watch the attention economy, control it. Start investing in what controls your attention.